Good afternoon. Thank you for joining our Total Enterprise Management webinar. We're about to start, so we will convene to a quick video and then we'll come back to our presentation.
More than 90% of investment returns come from asset allocation decisions. But get this, those who make asset allocation decisions often have different vantage points that don't align the investment program with the goals and objectives of the organization. They're each approaching the same puzzle with a different picture of how it should look. For foundations and endowments, this means something will be neglected, from short-term operating needs to long-term growth of the investments. Scholarships and research initiatives suffer. Grants shrink. Programs evaporate. NEPC gives organizations a 360-degree view of needs, risks, and long-term strategy with total enterprise management. First, we thoroughly assess the goals and objectives of each stakeholder, helping the entire investment committee see the big picture. We ask, what does success look like? Next, we determine your operational reliance on the investment program, eliminating your risk profile. We integrate short-term operating needs with the long-term investment program. We emphasize choosing the strategy that gets asset allocation right. Total enterprise management gives you the peace of mind that your investments are on the right track. Reach out to an NEPC endowment and foundation consultant today.
Good afternoon and welcome. Thank you for joining us for NEPC's discussion on Total Enterprise Management, or as we like to call it internally, TEM. My name is Sebastian Grzejka. I am a senior consultant on the Endowment and Foundation team. And Kristin Reynolds, who's here with me today, is the architect of Total Enterprise Management and will walk us through it. Our plan is to spend the next 30 minutes with you to introduce you to TEM and help you understand how this could work at your organization and detail NEPC's approach to total enterprise management. We will ask you 4 questions, but ask that you hold them off until the end of the presentation. The way to ask questions is through the comments section of your webinar, which is on the bottom part of your screen. So Kristin, let's talk about TEM. What can you tell us about total enterprise management at NEPC?
Sure. Well, thanks, Sebastian. And if anybody has worked with Sebastian and I before, you know we've worked together a very long time. So putting this presentation together was like getting the band back together. So we are excited to be here. And we'll start to talk about Total Enterprise Management, which is a proprietary tool that we built at NEPC to help organizations match their short-term liabilities, or really just paying the bills of the organization, with the long-term assets of the organization, or in our case, the investment pool. It focuses on understanding the spending draw from assets. So I'm going to use that word a lot, spending draw, and I just mean the spending policy, the spending rate applied to your assets. And I will call it spending draw or spending draw from assets. It focuses on that, plus how it interacts with your operating budget and other key forces for the organization. Because for us, we see spending as the direct link between the investment assets and your organization. We developed this tool in 2008. It was really to help organizations talk among their key decision makers, like the board, investment committees, finance committees, staff, CFO, and help them rebuild their programs in line with the organization's needs.
So why should investors be interested today? And the markets have been really strong for the last decade.
So today, we think the need for total enterprise management is resurfacing as organizations are really struggling with lower return expectations, pressure to reduce their spending rates. Even fiduciaries are changing their roles. Investment committees are changing. And there's a goal to sustain and grow the organization's mission all the while.
So what exactly is at odds?
So as the U.S. economy grows, more organizations have discussion around strategic goals and increasing support for their mission. So this tends to be directly at odds with what we've observed for spending trends. So here you can see the recent trends for spending in private foundations, community foundations, and university endowments. So on the left-hand side, private foundations are spending more in the recent past, up to almost 6% of their portfolios. And that's really telling us that some of the strategic vision and mission-related aspects of the organization are more in focus today, and that the near term is affecting the longer term. The future considerations for generations getting the same value as today's generation. And again, I'll stop here to call that intergenerational equity. What endowments and foundations are focusing on is making sure future generations get as much value out of the organization as they do today. And then by contrast, we see university endowment spending has actually decreased. And this actually might be a nod towards their changing industry. So you think about the education industry changing over the long term. They're reducing their spending to ensure that intergenerational equity. So to better understand this pain point a little bit, we'll also show you that there is an increasing share of institutional investors that are concerned about expected rate of return meeting their needs long term. So if I said it another way, just to put this in context, if you're a private foundation spending that 5% and that's increasing to closer to 6%, and the expected return of your portfolio is really only 7%, then your foundation may lose value in real terms over time. And then by contrast is that university, they're reducing their spending and they're placing pressures on their near-term objectives and relying more heavily on fundraising to close the gaps in growth. And we've also seen fundraising been a little bit soft over time. So near-term versus long-term pressures. Now, while investors are concerned about lower expected returns, it also seems like investors are looking in the rearview mirror and concerned about opportunity costs. Hindsight's 2020 after all. So the top chart is showing you the S&P 500 in blue. And the S&P 500 is a proxy for the U.S. equity. And you can see a decade from October of 2008 until now of uptrending equity markets.
Well, the U.S. markets have been a great place to be.
Yes, but what I found interesting is the bottom chart. So these are Google searches, and you can look up in Google trends of what people are searching for in Google. And after about 5 years into this bull market, you can see that the blue line, which is representing the diversified investments or people searching for diversified portfolios, it declined to almost non-existent. Now, if you look at that red line, more recently, that red line, which is representing price to earnings ratio or a proxy measure of market valuation, that red line has increased. So from this, I am inferring that after a decade long of run up in the S&P 500, people may be desensitized to market risk and maybe less concerned about diversified portfolios. Maybe they have diversification remorse, I'm not sure, but it does look to some signals of pointing to valuation concerns as well. Now, really, that's all for fun because there isn't any statistical significance to what I just showed you, but it does play a role in what we're talking about in investment committees. If you are thinking about what people are asking about in investment committees, you know, how come my portfolio hasn't kept pace with the S&P 500, or questions about why diversify outside of the U.S., and so anyone with a diversified portfolio knows that diversification has not been a benefit as of late. So more to the point for our listeners, your organizations may be facing their own environmental and organizational pressures. And understanding those pressures will help build a robust risk assessment for your organization. And once we can know that, we can build portfolios that meet your needs and that reduces the noise that I just introduced with the last 3 slides.
So where should we start?
Risk. Risk can both be an opportunity and a threat, and it can be mitigated or accepted. And knowing where your organization stands is the key to knowing how to proceed with risk. So I searched for a lot of definitions for risk to find the perfect one to capture in this presentation, but I didn't land on anything that was just right. But what I did find was that a lot of definitions of risk have 2 common characteristics. This idea of uncertainty which is whether an event happens or not, and impact, which is the magnitude of the event. And what I really liked, and I thought was captured well for this discussion, was that while we try to quantify risk, it's really just perceived until it happens, and then it's an event. It's in the past. So this gives us the opportunity to build a roadmap for being proactive ahead of the event. So let me just give you an example here. There may be many institutions that could accept a 40% drawdown of their portfolio mathematically. But the question is, how do stakeholders react? So let's keep this definition of risk in mind as we see some examples for how clients use total enterprise management.
Where does that take us from here?
Well, I think the Cheshire Cat says it best. He says to Alice, if you don't know where you are going, any road will get you there. And that's my jumping off point for why people need total enterprise management. Most organizations silo their investment decision from the mission of the organization. And we believe it's that practice that drives less optimal results.
What should clients expect from our approach?
So our process for total enterprise management is twofold. It takes a two-pronged approach to understanding your needs and helping you articulate those needs and memorialize them. The first step is to survey the key decision makers and get their anonymous point of view about the organization's risk tolerances and behaviors. We do this because individuals come to problem solving with different lenses and experiences, and we want to collect those. This is precisely what drives groups to better decision making. Although I bet you sometimes feel like that the differences are what get in our way to making good decisions. This tool is actually helping us level set that. The second is an operational assessment of organizations and their key needs. This links the operating budget with the reliance on spending draw and integrates that reliance into the asset allocation decision. Together, we put together a 360-degree review of the risk assessment and help the key decision makers pull the puzzle pieces together. We use this risk assessment to flesh out the true risk profile of the organization, and then this informs the asset allocation process. Simply put, we first need to know which risks we want to take and which ones we want to mitigate. And so the best part for me is it usually spurs robust discussion with the decision makers. In the end, it is our goal to help you match your investments to your organizational needs. So at NEPC, we also bring diversified experience to the table. Our client exposure is diversified across endowments and foundations who have a variety of different needs and challenges. But overall, our clients have expressed concern with the operating environment for their organization, with the challenges in giving and in fundraising, with their organizational or governance structure, again, the changing roles of the investment committees and the board versus the organization, and then the overall market environment for investing. We try to bring our diverse experience to problem solving for your portfolio and your organization. So in the next section, we're going to look at 3 different experiences as a way to describe the challenges clients face.
So you had mentioned a number of surveys or assessments, risk assessments. Let's talk about how they work.
So the first survey focuses on the operational budget and asks high-level questions that help us define your organization into 3 buckets. These buckets are a little bit neat, so really it's only the starting point for the discussion for us. But it does help us quickly understand the sources of income for your organization and how it relates to the reliance on spending draw from those assets. The second survey is what goes out to those key decision makers. We ask a series of questions that help us understand how the individuals, again anonymously, view the organization and its investment activities. So this is the place where we're also able to level set the discussion by understanding where people have a high agreement, which I've highlighted in green, a moderate agreement in yellow, or low agreement in red on the various issues or questions we've asked. So what you're seeing on your screen right now is an actual survey taken earlier in 2018. So if you could imagine for a moment that you take a survey and then you get a score on this more risk adverse, less risk adverse arrow from 1 to 10. So imagine a left to right scale from 1 to 10. The color, again, indicates the level of agreement. Based on the results, you can see that most operational metrics were moderate, so they're falling in that center column. But there was a place where this committee had low agreement on the drawdown of assets. So they had about equal weight to each one of the buckets across from left to right. And they were pretty evenly split, and that really spurred a good conversation about what risky assets do in a portfolio. And then from a behavior standpoint, so asking how they interact with the assets, there was absolute agreement in the center on peer rankings. Everybody thought that peer rankings were one measure, but not the ultimate measure of overall performance. But we did have that low agreement on a question about volatility. 60% of the respondents here thought volatility wouldn't matter. After all, they're long-term investors. They shouldn't care about volatility. And 40% thought it would have a profound impact on the organization. And so what we found in the end, when we had a discussion about why that would be so polarizing, was that one group wanted to rely more on the spending draw, which made them feel like volatility would really impact the organization. And the other group thought that the fundraising campaign that they were undergoing was so successful that they should worry less about the spending draw. So that was part of the organizational questions and answers that we had during that meeting.
It's great to see an example of this, but do you have a real-life example for how it worked for a real organization?
Sure. So again, we're back to the operational assessment. And here you're looking at an operating foundation, and they generate revenue from activities, but that only represents about 20% of their income, of their operating budget. So the remaining 80% comes from the spending draw from assets. So again, they're a private organization, and they are not meaningfully fundraising. And so following this series of questions about their organization, we figured that they fell in the yellow bucket, which is pretty reasonable for most investors. It tells us that they are long-term investors, but not completely agnostic to risks like drawdown and illiquidity.
Why is that?
So here on the next page, you can see that they rely heavily on that spending draw in blue to pay their expenses, which here are in red. The way this works is that the client shares with us their income, their revenue in green, and their expenses in red for the next 5 years as part of their operating budget exercise. And based on the asset allocation that you choose, NEPC derives the spending budget, which is in blue, the spending draw here. So green plus blue will be income for the foundation, and red are expenses. And so the reason they fell in the yellow category is because they rely heavily on their spending draw, which is 80% of their operating budget. But you can also see here that their spending plus revenue exceeds their expenses. This gave them a little bit of wiggle room to take on maybe some new initiatives or spend more dollars on mission or even reduce the expected return of their portfolio overall. There were a variety of other changes that they could make, but the point of this was it was the starting point of the discussion for linking the assets right to the organization. So if we get back to this concept of risk staying on this operating foundation, I'm showing you what they need to spend on an annual basis, which is that gray dashed line down the bottom. It's helpful to understand what they need to spend in the context of different market environments or how their assets perform in, say, a recession or an expansion, or what we even think in the base case scenario for their expected results. The dispersion of spending you see in the top part of the chart, which is the base case recession and expansion levels of spending, exceeds their spending need in most market environments. So what we're doing here is we're taking the spending need, which is the break-even level from the difference between expenses and revenues from the previous chart. On an annual basis, they need to spend about $16 million, but based on their current asset allocation, they can expect to draw about $19 million. Again, this gave them a good buffer to make decisions about strategic initiatives. Where we had some really robust conversations was around that gray line exceeding the red line, or the recessionary spending draw. And we asked if they could reasonably withstand the impact given the probability of this scenario, which is relatively low. And if they could, then they should be comfortable with their asset allocation decisions, which they were. So this is the actual user interface for our tool, and I only show you this because I wanted to show you that once we get the inputs from the client, it is pretty flexible what we can do with this tool. And it's important, as I said, to stress test the organization and the portfolio in different environments. And the fact that we can stress test the organization is really what makes our tool different. We capture the organization independently from the assets and then go back and integrate them. So in this case, the stress test case, you're looking at a global recession. And if you're looking at the left-hand side, the selections we made were, we assumed that we were going to enter a recession for the investment pool, and that our operating budget would hit the worst-case environment as well. And so you can see here that our revenues in green plus spending in blue do not meet the expenses, which are the red bars. The impact of this actually accumulates to $17 million over 5 years for this organization, all the while their spending needs increase because their budget is in the worst case scenario. So this is a pretty dire circumstance that we do not manage to, but at least we can assess the impact and have a roadmap for how we would react.
So how about revenue generating organizations? How would they differ from this?
Okay. So here's a typical mid-sized university and how they might fall on the operational spectrum. So for this type of organization that they have revenues from tuition and other, the green bucket makes sense for them. Oops, losing my page. The green bucket makes sense for them. They are fundraising to their endowment every year. They have revenues, and so they're in relatively good shape. Importantly for us, when we think about green bucket investors, is that they certainly do not have the same risk factors as yellow bucket or red bucket investors. And you find that yellow bucket or red bucket investors are often trying to compare themselves to green bucket investors. And so you can think about the discussions you might have in your investment committee meetings about looking at the returns of Harvard and Yale. But these are certainly different investors, and let me tell you why. Their operating budget of this mid-sized university, their green bars, which are their revenues, almost meet their expenses. So they have very low reliance on their blue bucket, their blue bars, which are their spending. So this actual conversation that we were having for this university led to the uncertainty factors being more around the challenges the educational industry are facing and what they need to do to invest in the future and how they want to grow the endowment per student. In fact, these folks want to double in size over the next 10 years.
Do we have any clients that fall into that red bucket?
Of course. So this particular client is not expecting any ongoing contributions from their asset base, and their asset base is pretty small relative to their spending needs. So they fall into the red bucket. In fact, It's this client's policy to only spend what they earned in the previous year off their investment assets. And so as you can imagine, the asset allocation policy for this client is very different than from the other two. And in putting this presentation together, what sort of struck me is that the mid-sized university the green bucket investor, invests more like the private operating foundation and more like a Harvard or a Yale.
Based on everything you said, there seems to be a disconnect between that.
Right. So it was their investment preferences that drove them to this policy, for better or worse. This is how we tie together that two-pronged approach, by pushing committees to think about their true risk profile and successful outcomes. In the end, the mid-sized university took comfort in a U.S.-centric, highly liquid, very cost-effective approach to investing, but are committed to understanding when this approach may underperform their stated growth goals of doubling the endowment over the next 10 years.
So we've talked about a lot, green, yellow, red boxes, different universities and organizations. What are my key takeaways today?
Okay. Importantly, we are helping clients build that roadmap that we've talked about that describes the learnings from total enterprise management. The roadmap includes the definition of goals and objectives. It includes risks that we have identified that are unique to the organization, as well as risks that we want to accept or mitigate. Together, that's what helps us determine our long-term asset allocation. We've also found that a statement of investment philosophy helps to memorialize those learnings. The statement generally surrounds beliefs about the market, asset allocation, and manager implementation. And this really helps the committee track and measure their performance relative to their overall philosophy. And as always, we have that ongoing feedback loop to the operating budget by revisiting total enterprise management on an ongoing basis. At the core of our process is a strong belief that there is no one right answer, that there is no one right model. We use a mosaic approach to give us different perspectives on organizations and portfolios. As a result, much of what you'll hear from us is focusing on the big picture and strategic decisions. We know that if you get the big decisions right, you'll have less to worry about over the long term. To us, this is what highlights the importance of total enterprise management.
Kristin, thank you for this. It's a very, very interesting topic and one that we would love to talk to all our clients about. So at this time, we do have some time for questions. And perhaps I'll start it off with a few. This process seems daunting. There's a lot of inputs in it. How long does it usually take, and what data is needed to complete a survey?
Sure. So we tend to do this off-cycle before we do asset allocation. And if you're a client that works with us, you know that we revisit asset allocation usually in the first quarter. So from beginning to end, we have a pretty neat survey of about 10 questions that we need answered by your treasurer or your chief financial officer. And we ask a series of questions around revenue and income. A lot of that is what CFOs are reporting on their Form 990, and so it can be pretty easy for them to obtain. So that part is probably the longest part of the process. Once we get those inputs, we also send the individualized survey. Usually we give investment committee members a few weeks to respond to that. Altogether, from beginning to end until the output of the product, I'd say just a couple of weeks, depending on how fast we can get the inputs. Like I said, once we have clean inputs, it's pretty flexible.
So I'm thinking about the outcome of these and relating it back to the clients. I mean, what have the outcomes been, and have the results in any change in philosophy or approach? Yeah,
so over the years, we've seen some interesting outcomes. One client, after we did the total enterprise management, actually changed their policy spending rate. They previously said we would spend 4% every year. And we actually found that if they spent 4.5% every year, but took that and moved that to a rolling 3-year basis, they could smooth the volatility of their spending draw and still meet the organization's needs new strategic initiatives while not impacting their assets. So they had a little more wiggle room, and they chose to increase their spending rate, which not a lot of people are doing in this current market environment. We had another client, when they were accumulating more spending draw earnings than they needed, they reinvested those in the assets. The conversation there was if the assets draw down, if we hit a market recession, then those excess earnings evaporate. They felt very comfortable with that, given the fact that they were long-term investors, and they also had some wiggle room. One client got a little taken aback by their spending needs and decided that they needed to do a fundraising campaign for the growth of their endowment. And a fourth client, a private foundation, was actually able to reduce the spending rate attributed to the fees for the foundation once they were able to think holistically about the expenses of the foundation. So a couple of interesting outcomes over the years.
It's quite an impactful tool to use when you're going through your operating cycle, et cetera, for the portfolios.
Yes, and again, we do it in conjunction with asset allocation, which makes it possible for us to link the asset allocation to the organization. So if there are no more questions from the phone, we will end it here. We've recorded it for you as well. And we, again, thank you for your time.